Welcome, everyone, to the Discovering Digital Assets webinar. We thank you for joining us today, and special thanks to the WTIA team for collaborating with us. This November will mark the third anniversary of our adventure into the world of digital assets. We wanted to share some of our learnings from those 3 years, which, looking back, feels like an eternity given the breakneck speed of the asset class. But before we get into things, I need to share a short disclaimer. Today's presentation is designed to provide insight into the world of digital assets. Nothing you hear or see today is intended to be investment advice. Information is being provided for education purposes only. We know many of you, but there are some new faces in the crowd, so we'd like to do a short introduction. That's me on the left. I lead the Strix Leviathan business development and investor relation functions. I'm joined by our CEO and co-founder, Jesse Proudman, and our Chief Investment Officer, Nico Cordiero. We plan to spend the first 25 minutes or so on a presentation, then open the floor up to your questions. Many of you submitted questions ahead of time, and to some extent, we've structured the content to address those questions. Other questions will be addressed during the Q&A. Without further ado, Jesse, let's get going.
We wanted to start with Bitcoin because everything in this industry started with Bitcoin. On October 31st, 2008, an anonymous character, Satoshi Nakamoto, released the Bitcoin white paper to a cyberpunk mailing list. Within this white paper, Satoshi described a technological way to prove ownership of digital assets, a major breakthrough powered by what Satoshi coined the blockchain. Prior to the blockchain, proof of ownership relied on a trusted third party. You had a bank that told you how much money you had in your account, and they store that in a central database. For money transfer, this is companies like Venmo or PayPal. But Satoshi's blockchain created a way to prove digital ownership and a way to transfer that ownership without being reliant on intermediaries. This blockchain invention set off the next decade of innovation in the digital asset space. And it really comes down to 4 key characteristics. First of all, the blockchain is permissionless. Anybody can interact with Bitcoin or with a blockchain. There are no gatekeepers. Second, it's decentralized. There's no single server, no governing party. The protocol can't be changed by a single person. Really, nobody can control the Bitcoin network because it's hundreds or thousands of individual entities all interacting with each other. Third, it's uncensorable. There's no way to block or reverse a transaction. Unlike bank accounts or credit cards where transactions can be reversed, once capital is sent across the Bitcoin network, it can't be returned. And lastly, anyone in the world with internet connectivity can access the network, and there are protocols, including satellite and radio-based transmission, that allow people without internet to access the Bitcoin network. The last key point that we want to touch on with Bitcoin is this notion of 21 million coins. The code that powers the Bitcoin network limits the number of Bitcoin that ever will exist to 21 million. Changing that number would require the collusion of all of the network miners who have invested hundreds of millions of dollars into equipment that can only be used to mine Bitcoin. So game theory suggests that they would be disincentivized to do that. This notion of 21 million Bitcoin really is a rallying point for many of the people that argue that Bitcoin is digital gold. There is a scarcity that exists here, knowing that there can only ever be 21 million of these Bitcoins in existence. So Bitcoin launched this notion of digital assets in 2008. And really, in our eyes, it's become this entirely new asset class that sits outside of the bounds of traditional finance. So real estate and global equities, oil and gas, government debt, fiat, all of these things exist in this world of traditional finance. And they behave and interact and are correlated in certain ways. Digital assets really sits outside of that. And we've seen this asset class grow dramatically over the past 4 or 5 years.
As Jesse described, it all started with Bitcoin, yet we're now presented with a vast universe of digital assets that serve different purposes. Bitcoin is a currency, or at least intended to be one, and we have stablecoins, which are fiat-backed digital assets. We have computing platforms that serve as the foundational layer for further digital asset innovation. We have DeFi, or decentralized finance, and many other things. We're going to go into detail on each of those categories. And while the taxonomy we present today is useful for understanding the current state of the asset class, please recognize that this is a dynamic and evolving space that doesn't sleep. Therefore, a prudent investor must continuously evaluate the universe to better understand the risks and opportunities.
We're going to start with digital currencies, of which Bitcoin obviously was the first. The world needs a digital medium exchange that's not controlled by a single nation state, and Bitcoin was the first attempt to do that. These currencies are attempting to be alternatives to the dollar, to the euro, and to fiat backed currencies around the globe. They're aspirational stores of value and mediums of exchange that are not tied to traditional currencies or assets. Because they are digital, they can be duplicated. In this industry, that's known as a fork, and the rules of the currency can be changed. A great example of this is Bitcoin Cash, which forked off from Bitcoin and changed transaction capacity limits to increase throughput on the network. Or Litecoin, which forked off the Bitcoin network to change the transaction speed. Many people think Bitcoin provides for complete anonymity, but the reality is the blockchain is a completely public ledger, and all transactions can be traced from address to address. These networks are pseudo-anonymous, and if a party can identify an address, they can trace transactions through the network. So Monero and Zcash were formed to create currencies with fundamental privacy features built in. The ability to obscure transactions with enhanced anonymity at the transaction level while providing the provable digital ownership that you get from Bitcoin or Bitcoin Cash. These are more similar to physical cash because they're not traceable at the ledger level. Within the realm of digital assets, these assets representing currency functions represent about 2/3 of the total market cap of the space. Next, we'll talk about stablecoins. Where digital currencies are attempting to replace fiat currencies, stablecoins are attempting to digitize those currencies and put them on a blockchain. Everything started with Tether, the first stablecoin that's been around the longest. And over the last couple of years, we've seen the rise of additional types of stablecoins, including US dollar coin and Paxos. Further, we get asset-backed coins like Paxos Gold that represent physical gold held in vaults on the blockchain. The objective with these coins is to digitize fiat, to create an easier path of transferring capital around the globe. Think about it like wire transfers. These become immediate and instant wire transfers that are much easier to use and don't have an intermediary. The key point here is that these are not speculative instruments. They're intended to hold their value. One US dollar coin should be worth $1 because the US dollar coin is backed by dollars in a bank account.
Blockchains not only power currencies and stablecoins, but they power entirely new forms of distributed computing. These new forms of distributed computing are essentially open source software projects that provide a base layer for building applications that anyone can use. You may have heard the term decentralized applications, or dApps for short. These dApps are powered by an invention called the smart contract. Smart contracts are essentially programmable software that can be used to enforce the terms of any agreement. For example, Jesse and I can create a smart contract that stipulates at the end of this webinar, he will send me 1 unit of Ethereum for $400. And the smart contract will automatically enforce that agreement by executing the exchange of assets without intervention from either of us or any third party. That innovation has really powered the creation of entirely new systems of computing. Ethereum was the first mover in this category of computing platforms and launched in 2015. Like Bitcoin, its first mover status has made it the largest platform in its category, but it also has a number of scalability challenges related to the size and speed of transactions that it can process. As you might expect, there have been a number of competitors to come to market that offer new ways to address those scalability challenges. Some of the more promising projects are Cardano, Tezos, EOS, and now the Polkadot network. That said, Ethereum is still the king of computing platforms, comprises 80% of the total market cap of the category, and has the lion's share of development resources focused on its innovation. One of the most exciting evolutions of Ethereum has been DeFi, or decentralized finance. DeFi, which is short for decentralized finance, is banking on the blockchain. It's a lot like banking, but it's also quite different. The goal of this movement is to provide uncensorable universal access to financial services like savings, borrowing, lending, and trading. The DeFi world is largely built on Ethereum and has been one of the hottest trends in 2020. It comes with an entirely new set of rules and its own lexicon to understand. DeFi enables banking without banks. For example, Jesse could take a loan out against his Ethereum holdings simply by pledging collateral to one of the platforms above. Jesse could do this in minutes without ever interacting with a loan application, a loan officer, or anything of that nature. Chainlink is a notable piece of the DeFi space as it serves as a data feed from the real world to the blockchain world in a distributed manner. The service that Chainlink provides is critical to the growth of DeFi. Whenever a DeFi platform or dApp or smart contract needs to reference a trusted data source, it can plug into Chainlink for that data. The DeFi space has really exploded in 2020. So what drove this pop? Well, one of the major demand drivers came from the DeFi protocols themselves. With the popularity of DeFi, many of these protocols have incentivized users to deposit or borrow from their platforms. In exchange, those users are commonly compensated with the protocol's token, kind of like a rebate. In order to encourage users to engage with their service, many of these DeFi protocols began offering incentives. Compound, for example, provides a borrower-lend service. On face value, the borrower-lend service looks pretty basic, but there are subtle differences. Compound, for example, provides a borrow and lend service. Lenders offer their assets to borrowers in exchange for yield. But to encourage more lenders and borrowers to engage with the Compound platform, the Compound team issued a governance token commensurate with the activity of each user on that platform. Lenders, therefore, would receive not only yield from borrowers, but also a governance token that began to trade on its own. Further, Compound started offering this governance token to the borrower side of the platform. When this governance token itself began to rise in value, you effectively had lenders earning two forms of yield on their deposits and borrowers earning a rebate that was in excess of their actual borrowing cost. Not completely normal, but nothing in DeFi is. What occurred next is something you might expect given the open nature and creativity of the entrepreneurs in this space. As other protocols began to offer their governance token similar to Compound, activity was incentivized, and intrepid DeFi players stepped in to take advantage of these incentives anywhere they could. This opportunistic gaming of DeFi incentives became known as yield farming. Of course, the sustainability of this digital agrarian practice is very questionable and relies not only on investor enthusiasm for the protocol tokens that are issued as rewards, but also in new money coming into the DeFi space. We've seen a dramatic cooling off of the DeFi space and yield farming in the last few months, but nobody knows if and when the enthusiasm will return. It's innovations like DeFi and yield farming that drive excitement and new players to this space and ultimately drive large speculative cycles across the entire digital asset universe.
The last category we want to talk about is this other bucket. And we can think about these as digital collectibles, games, or meme coins that exist really for fun within the ecosystem. These are primarily built for entertainment, but they're an important and growing part of the ecosystem because they can be traded. So there's economic activity that surrounds these. CryptoKitties was arguably one of the first collectible games that was created and has transacted over 37 million in total volume since its inception. At its peak in 2018, someone paid an eye-popping $173,000 for a particular CryptoKitty. Two of the most notable launches were recent NBA and MLB-based trading games. These utilize a concept called non-fungible tokens, so that people can prove digital ownership over specific players and trade them about, sort of like fantasy football, with the digital scarcity proven by the blockchain. Unlike baseball cards in the real world, where there's no way to prove how many a specific card were printed, these are able to be proven. Decentraland is another example. It's a virtual world where people can buy and sell digital real estate with scarcity. So while these projects seem like they're funny or for entertainment purposes, there's real money moving around here. So now that we've laid out the universe of coins, we want to talk about some of the opportunities and risks in investing in this asset class. We feel like these are really important to understand before you begin investing. In one perspective, diversification is a key benefit of this asset class. These assets have low correlation to other traditional assets, and that presents opportunities for portfolio diversification. Bitcoin, for example, is correlated 0.2 to the S&P 500 and 0.37 to the Barclays US Bond Index. The second big opportunity here is access to disruptive technology. Oftentimes, the best deals are limited to a small group of angel investors. But in this industry, you can think about all of these individual assets as liquid angel investing. Anybody largely can have access based on the exchanges available. So this gives everybody the chance to participate in early stage tech investing that's not typically available to the average investor. And lastly, there's extraordinary upside potential. This asset class creates an opportunity to compound capital at returns that are not available in other asset classes. Returns from 2017 to 2020 for Bitcoin were 636%, and for Ethereum were 1,476%. These are returns that you would expect from angel investing, not from traditional currency investment. By far and large, this has been the best performing asset class of the last decade, but it's not without its risks. We like to think about this market as a frontier market. There's a lot of risks that come along with that. One of the largest is this notion of fractured liquidity. The liquidity that exists for all of these coins is spread out across hundreds of exchanges around the globe. That creates execution and liquidity risks for holders of these assets. We've seen that with flash crashes. Assets have regularly experienced 90% drawdowns. We've seen that in 2018, and we've seen that in 2020. On March 12th of 2020, Bitcoin plunged 50% overnight. And while it recovered quickly, these wild swings in volatility can be nauseating to many investors. With traditional angel investing, you don't see the volatility in your investments, but it doesn't mean it's not there. With digital assets, you're living that volatility every day, and that can be incredibly emotionally painful. Additionally, there's custody concerns. Digital assets are bearer instruments, meaning that if you lose your keys to your coins, the assets are lost forever. There's no way to recover them. This is one of the benefits and the challenges of a truly decentralized network. And lastly, there's technical failure. There are 6,000 different tradable blockchain projects, and not all will survive. Projects can shutter and tokens can become worthless, and picking and choosing which ones will last and which ones will die is a big challenge that even experts can get wrong.
This is intended to be a summary of the risks and opportunities in the space. Of course, each individual asset has its own characteristics and its own risk and return profile.
Prudent investing requires understanding what you're investing in.
As you might expect, investor comfort levels for Bitcoin and digital assets are closely tied with age. Charles Schwab conducted a survey and found that millennial investors lean more heavily into technology positions, including Bitcoin, which was not only a part of their portfolios, but one of the top holdings coming in behind Amazon, Apple, Tesla, and Facebook. And behind millennials, we have an entire generation of investors who are digitally native, who will grow up in a cashless society and will study digital assets. Thus, it's reasonable to assume that these investors will be as comfortable with digital assets as millennials currently are. They won't be anchored by this dynamic of before and after Bitcoin. Bitcoin will have just always existed. Will they see digital assets as a core component of their investment strategy? Only time will tell. From an institutional perspective, we've seen digital assets, namely Bitcoin, hit the headlines in a really big way during 2020. Famous global macro investor Paul Tudor Jones has added it to his fund. Two public companies, one listed on the NASDAQ and the other on the New York Stock Exchange, both added Bitcoin to their balance sheet in exchange for US dollars. What is driving this interest? Well, in these circumstances, it seems like it's an inflation hedge. We're witnessing unprecedented levels of monetary stimulus, growing sovereign debt levels, and an expectation of slower growth. Bitcoin has come a long way since its status in 2008 and is now a feature at many of these prominent institutions as they try to tackle their own asset allocation challenges.
So we've provided you with an overview of this asset class, and we wanted to provide you with some of the lessons we've learned trading it over the last 3 years. First, while the market cap of many of these assets is large, liquidity is often thin in all but the largest of markets. This has improved dramatically since 2018, but it's still something you need to be conscientious about when you're making decisions about where to allocate your capital. Second, as bearer assets, counterparty and exchange risk is high. It's not a question of if, but when you'll have to deal with this. Third, the regulatory environment is opaque and rapidly shifting. This makes the cost of doing business in this industry very high. Fourth, the velocity of change on a day-to-day basis in this industry requires full-time attention to understand new projects and trends well enough to intelligently allocate capital. For us, that means we trade what we know. We don't necessarily follow the trends, and we don't necessarily follow the hottest tokens. We really make sure that we have an understanding about where we're allocating our capital. Fifth, these really are speculative markets. No one has any idea where price is going, but we all know it's going to be volatile on its way there. News and sentiment is very geographically focused, but pricing pressures are global across an almost infinite number of reasons to buy or sell. The price can go up and the price can go down, and it will do so many more times. And lastly, it's really easy to feel like you're late to the party, but this entire industry is still so early. The market cap of the entire digital asset class at $356 billion is still a fraction of the total market cap of traditional assets.
And that concludes the presentation segment of this session. We're now going to transition into a Q&A session. So I encourage everyone in the crowd to go ahead, hit us with questions on the Zoom link. We're happy to cover anything you'd like to talk about, but we've also gathered some questions in the days leading up to the conference. So we'll go ahead and start with those. Okay, here's a question, Jesse, that you can address for us. One of the attendees has asked, how do you view the relationship between Bitcoin and blockchain? Does Bitcoin need to be successful for blockchain to be successful? How do you think about that?
So Bitcoin obviously invented the blockchain. It was the first technology and first currency available to be powered by that technology. But it's not a requirement for blockchain to continue to be successful. I think there is a tendency now to conflate sort of the success of Bitcoin with blockchain in general. But there's also this tendency to think that blockchains are needed for everything. By far and large, blockchains are a pretty inefficient technology. They're decentralized database. They're slow. They're clunky, and they're that way because of the need for decentralization, for the need for the permissionless nature of the asset class. So there's a bunch of characteristics about having this sort of uncensorable network that make blockchain necessary. But a lot of sort of, you saw this a lot in 2017, a lot of projects or initiatives that were starting saying we need a blockchain, we're doing it predominantly for the hype or the buzz and not really benefiting from the benefits of that network itself. So I think Bitcoin can be successful independent of blockchain. And I think blockchain can be successful independent of Bitcoin, but really kind of finding the use case that makes utilizing that technology important. That's a key.
Yeah, really well put. Thanks. Here's another one that I think aligns really well with your role, Nico. So when evaluating new investment opportunities in the digital asset space, what's the process that you follow broadly?
Yeah, so we are systematic traders focused on very short duration positions. So much of our focus on market selection tends to move towards, one, the statistical behavior of the asset, liquidity, and most importantly, the security of the underlying protocol. So an example here would be Bitcoin Satoshi Vision, which was a hard fork from Bitcoin Cash early in the year. That popped in our radar because of the statistical behavior of the asset, but due to low liquidity and the fact that most of the network security is controlled by one mining entity, we just didn't trade that asset. So so we're highly focused on liquidity and security as short duration traders.
Got it. Very much appreciate that, Nico. Thank you. Just taking a peek here into the question bar. Jesse, during the presentation, you touched on this notion of fragmented liquidity. Given the size of the digital asset space, being somewhere between 300 and 400 billion, how do you go about evaluating liquidity at Strix Leviathan as it pertains to managing investments? Do you see your approach to be scalable?
Yeah, it's a good question. So I think this is really important as it comes to the whole notion of DeFi. So one of the biggest initial use cases of DeFi was this notion of a decentralized exchange or a DEX. And traditionally, sort of 2017, 2018, 2019, you bought and you sold digital assets on a centralized exchange. These are the Coinbases or the Bittrex or the Binances of the world. So it's a single entity. You send your capital to that exchange. They hold it in a big shared account, and then they have a ledger that you're sort of swapping assets to and from within. A DEX, everything is done on chain. So you send your capital to this DEX. It's held there, and then you can swap it to other assets. And what's different between those two is this KYC AML notion. So a centralized exchange, by far and large, has regulatory requirement to know their customer and to prevent money laundering through their platform. And DEXs, while probably legally still have that requirement, because they're decentralized, it becomes almost impossible to enforce that. And so you end up in this world where you have liquidity sort of fractured amongst all of these different trading venues. There are hundreds of exchanges, and they all trade the same assets, and they may be centralized and they may be decentralized. So you sort of think of traditional stocks. There's one place you go for a stock that's listed on New York Stock Exchange. There's sort of one trading venue. But with Bitcoin, for example, you can go to hundreds of different places and trade. And so that means that the liquidity is spread out across all these venues. And it also means that price impact on one venue, price moving on one venue, can ricochet and ripple out to other venues. So for us, we spend a lot of time making sure we understand the liquidity profiles of the assets that we trade, particularly as it relates to the size of trades that we make. So if you're trading as a hobby or you're just investing in the space for fun, and the size of trades you're making is not very large, the impact to the market from your trade won't be particularly large, and the execution costs or the slippage, effectively the amount you pay above and beyond what the actual spot price of the coin is to obtain your currency, won't be big. But as your trade sizes grow, that could be a really material impact on your trading. And so we've seen for certain coins, sort of as Nico mentioned, is we evaluate that liquidity, and we've seen execution costs range as high as 300 or 400 basis points, so 3 or 4%. So we really study sort of the size and liquidity of the markets for the tokens and currencies that we trade, and make sure that as we're moving in and out, we have predictable execution costs.
Very good. Very good. Thanks for that, Jesse. We have a question here from Angie. Since the market is very volatile and this industry is somewhat like the wild, wild west, how can amateurs like Angie get good information, make good decisions on investing? Where can they learn more about this industry? Angie, this is a really good point, and one that we're glad you posed to the group. We plan to send a follow-up email to all the attendees with some of our trusted links, if you will, and trusted information sources in the industry that you can jump into and use to do your own research. Jesse or Nico, anything to add there in terms of evaluating info on the digital asset space?
I mean, some of the best information out there is the dev blogs, which surprisingly few people read. So if you're interested in an asset or a protocol, I mean, locate that developer blog, read through what they're doing, read through what their roadmap is, and just try to understand it to the best of your ability.
Got it. Okay. We have a question about AML and KYC. So I'll pose this one to you, Jesse. Given the seismic impact of KYC and AML on centralized exchanges for everyone being those like Binance and Coinbase, how do you see the impact on KYC and AML on decentralized exchanges or in the DeFi space where anonymity is largely preserved?
Yeah, this is an interesting challenge for the decentralized exchanges. So I think legally, as I mentioned earlier, they're required to the same extent to practice KYC and AML, but it's just not technically possible with the way they're implemented. So this is one of those regulatory gray zones that we're in. The big notion here, and the one I really think is important, is you can't onboard new fiat capital. You can't take US dollars directly to a decentralized exchange. So you have to go through some centralized venue, whether it's a stablecoin issuer or an existing centralized exchange, to convert your US dollars into a digital asset, which then you can trade on the decentralized exchange. So there's always sort of that step one to obtain your first set of assets. And once you've gone through that centralized exchange, you now have sort of an address that can be tagged and traced through the blockchain. So I think there's a lot to be determined here over the next year. And certainly as we've seen the SEC come down on platforms like BitMEX within the last 2 weeks, BitMEX is one of the largest trading venues for derivatives in the cryptocurrency space. I think we're going to see similar focus from the SEC or the CFTC on decentralized exchanges over the next couple of years.
Good stuff. Very much appreciate that. Nico, here's a question for you. An audience member has posed the question about return expectations in this space. Everyone's trying to look out and position their portfolio accordingly over the next 12, 18 months. So can you give us a sense of how you think about the future performance of digital assets and where somebody might look to get more information there?
Well, in terms of return expectations, I'd probably say price predictions have an incredibly low hit rate and accuracy. The truth is, nobody really knows what the price of anything is going to be 12 months from now. At the beginning of the year, the dominant narrative was solely focused on Bitcoin and the Bitcoin reward halving, and how that was going to be the final death blow to other digital assets as Bitcoin runs itself to 100K or $100,000. Instead, the market gave us Bitcoin being outperformed by the vast majority of the market on both a gross and risk-adjusted basis. So in terms of positioning a portfolio, it's really understanding both what are real assets, not scams. The space is full of scams, doing your own research. And I'd also pay attention to momentum. These markets are extremely reflexive. Once things start to get rolling, things tend to keep rolling because nobody knows what the ceiling is and nobody knows what the floor is.
Jesse, you talked earlier in the presentation about stablecoins. We have a question about central bank issued stablecoins. What's your view on how these would impact the broader digital asset universe? Is any country closer than others to issuing their own version?
Yeah, central bank digital currencies are fascinating. And China, just within the last week or so, has actually prototyped and released into the wild their first version, issuing a couple hundred yuan to a number of citizens in a number of jurisdictions. So it's out there, it's working. I saw a Twitter video this morning of somebody paying for a coffee with their central bank digital currency. I think it's a two-part question to me. To one side, so one, I think it's very validating around the technology and proves the notion of blockchain and the ability to transact with that technology. The flip side is that these are sort of gated communities. I don't anticipate that the Chinese central bank digital currency will be able to sort of transmit funds to traditional crypto exchanges. My guess is they will kind of want to keep that all within the walls of their garden. So, kind of thinking through, does that help the broader crypto ecosystem? I think is to be determined over time, and will change over time. But broadly speaking, showing that the technology works, I think, is a monumental step.
Okay, well put. Appreciate that. Thank you. Nico, one of the attendees has posed the following question on digital assets. Much has been made about crypto and digital assets are very much in the Wild West. They're far riskier than other investments, certainly riskier than stock investments, or at least that's the perception. How do you react to a statement like that?
Well, I would agree with that statement. Without a doubt, digital assets are more risky than equities. Besides higher levels of volatility, greater tail loss, which in itself does not explain the totality of risk in these markets. The real risk in these markets are the unknown unknowns. So protocol failures, smart contract vulnerabilities, various attack vectors, both on the underlying assets and on the protocols themselves. So it's definitely more risky. But that risk, all these unknown risks, is why you have the type of return and volatility set up that you cannot find in other asset classes. So there's definitely an opportunity there, but I couldn't stand here and tell you they're not more risky than equities.
Great. Yeah, I appreciate that. Jesse, we talked a little bit about new capital coming into the space, and we've seen this with public companies. We're seeing it with generations of investors who are younger, more comfortable with blockchain, more comfortable with the notion of digital assets. What are some catalysts that could lift the digital asset universe kind of to that next stage in terms of size, adoption, and features in an everyday portfolio?
Yeah, so these are speculative markets, as we mentioned. So the price goes up when there's more demand than sell side supply, and the price goes down when that's inverted. So 2017, we saw sort of the tremendous rise in asset prices, primarily fueled by the ICO boom. You had a lot of speculation around sort of that new funding source. You had a lot of successful projects, and you had an even larger number of sort of fraudulent projects and failures. But that caused sort of the broader retail community to invest significant sums of capital into this space, thus pushing up price. I think following 2017, there's been this notion that institutional capital will be the next big wave. And that's sort of been the drumbeat over the last couple of years. Institutional capital is coming. Institutional capital is coming. Just wait for that institutional capital. And by far and large, it hasn't materialized up until sort of the second half of 2020. I think there's a number of reasons there, predominantly centered around that regulatory uncertainty. It's very difficult for regulated entities, or has been very difficult for regulated entities to interact and or hold these assets. The traditional venues that they're used to interacting with, the custodians that they work with, sort of all the infrastructure has been missing. It continues to be missing to some extent, but that has gotten better with entrants like Fidelity into the marketplace. You're beginning to see institutions that are sort of well regarded, and well regarded with great brand recognition in sort of the traditional financial realm, be part of the ecosystem. But this back half of 2020, with sort of this notion of public balance sheet buying of Bitcoin, that's really been sort of the first big fundamental shift. And really in the last 6 weeks or so, we've seen three pretty meaningful public company commitments: some MicroStrategy's investment, Square's investment,
Right.
And then we had a large macro fund make an investment recently. So that kind of transformation, I think there's more of that happening. It just hasn't made public yet. And I think we'll see more of that happening over the next 6 to 9 months. That feels like probably the largest catalyst to me to the next potential movement, because that really is the largest sum of net new capital that could enter the space at this time. You just look at corporate treasuries, like the amount of cash sitting on balance sheets of these publicly traded companies is astronomical. And if a proportion of them decide to make a similar investment, I think we see a significant new sum of capital enter the space.
Very interesting. And a natural follow-on question to that for both you and Nico. As that new capital comes into the space, how does that change how you think about Strix Leviathan's business and how you navigate the trading opportunities in the entire digital asset universe?
I'll let Nico go first on that one, and then I can share some thoughts.
Yeah, I mean, well, for one, it's going to get more competitive, but we look forward to that. I think, two, is the next biggest thing is liquidity. I mean, liquidity dries up super fast in this space, particularly when things are going against the current trend. So I think the more money we see flow into the space, the better liquidity, the better execution cost, more saturation of different assets as people start moving down that crypto risk curve.
Makes sense.
I think we also see sort of a sophistication of tools. So when we started in 2018, the tooling available to a sophisticated fund was basically non-existent. We ended up building our entire own platform to do that for our vehicle. But we've seen a lot of tooling come online over the last 2.5 years, and particularly around sort of the service provider space. So the custodians to hold these assets, the third-party administrators to help do the accounting for these assets. So much of that has improved significantly over the last couple of years, and will continue to improve as more sophisticated market participants enter the space. And that's just helpful to everybody here.
Very interesting. Thank you for that. Nico, I know you're well familiar with the Bitcoin stock to flow model. This is a model that's been popularized by the Bitcoin bulls and the Bitcoin maximalists, really justifying their view that Bitcoin will have long-standing staying power, if you will, in the industry and will grow over time. We think you have a view on that model. Would you like to share that?
Sure. I mean, well, to start off with, the stock to flow model is not actually a predictive model. It's just a slope intercept equation of Bitcoin's historical price patterns. So without getting too deep into the math, because the stock to flow rate of change on the stock to flow variable from one time step to the next is 0, the calculus underlying OLS ends up just projecting Bitcoin's historical growth rate. And, beyond the math argument too, from a logical standpoint, the model is basically arguing that that an inflation and supply rate that was known entirely in advance and scheduled would influence future market participants, as if someone out there is waiting for the stock to flow value to increase at each Bitcoin halving rather than just piling into the asset now.
Right.
So yeah, I mean, I personally don't think very highly of it. I think it's a misapplication of ordinary least squares regression. And you're basically just making the the old, because Bitcoin grew by this in the past, it will grow by this in the future.
Right.
Project.
Okay. Interesting. Yeah. Just extrapolating what has happened historically is definitely an exercise that's full of risk. So thanks for that, Nico. We have one final question, then we're going to wrap it up and let everyone head to their respective breakout rooms. Jesse, you talked during the presentation about digital asset investing being quite similar to liquid angel investing. I think that's a really interesting comparison and would love to hear a bit more about how you think about it.
Yeah, so let's start with what angel investing is. So that's where accredited or sophisticated investors write early stage checks into entrepreneurial companies with the hope of sort of finding the next unicorn, the next billion-dollar company. And much of the thesis there is that you make a lot of angel investment checks. You write a large number of small checks. Most of those fail. Some of those are okay, and you get one or two that are wildly successful, and that sort of makes up your portfolio. It's very similar to this notion of venture investing, but it's done with smaller check size at an earlier stage. The challenge there is that by far and large, the best deals aren't necessarily available to all angels, and aren't accessible to everybody. Right? You have to be an accredited investor first off, and then you have to have access to the deal to participate at all. Then once you're in an angel deal, you really don't have liquidity until later rounds or an IPO event. And so you're sort of locked up in this investment for a long period of time. Cryptocurrency is a bit different. So you have, with these tokens, you have the ability, or anybody has the ability from a retail perspective, to invest in these protocols from the very earliest stage. And so you get this avenue to have access to things that you wouldn't otherwise have access to. That retail investors have access to investments that they wouldn't otherwise have access to. And I think it's really compelling. The second piece there is that they're liquid, right? You can trade all of these assets on a regular basis. And so you can see the value of your investment portfolio in real time, which to some extent can allow you to make better choices about what you hold and what you cut as the market matures. So it's this almost democratization of access to investing. That said, it also comes with its own set of risks and challenges, given the fact that sort of anybody can start these tokens, and there's really no regulatory body that makes sure that things are on the up and up. So with sort of that opportunity comes a commensurate set of risks that needs to be paid attention to. Thank you for joining us today on the Strix Leviathan Discovering Digital Assets webinar. You can find more about Strix Leviathan, including our research, on our website at strixfund.com. If you have any questions on the content we covered here today, please feel free to reach out on Twitter at Strix Leviathan, on LinkedIn, or on our website. We'd be happy to help.